Hello everyone, we're going to do a review exercise for Chapter 15. And while Chapter 15 specifically focuses on investments, in my time as a professor I have found that the big hang up on this comprehensive assignment on the material covered in Chapters 13, 14, and 15 combined is the word common stock. Because common stock can mean a lot of different things. If our company issues its own common stock, we record that under one account, which is our common stock account. If our company buys back its own common stock from shareholders, well, then it becomes treasury stock. And if our company buys the stock of another company, well, then it gets recorded as an equity investment. So the word common stock can be quite confusing, and I think it requires extra focus to break down when you see common stock in there, how are you supposed to record it? And it all centers around the concept of what are we doing with this common stock and whose common stock is it? So I'm going to run through some very stock-specific questions in this exercise so we can differentiate when do we record something as common stock, treasury stock, or an equity investment. And the first thing we have is that on January 1st, Company A's Board of Directors is going to authorize 100,000 shares of $2 par common stock. Well, the word authorize is a dead giveaway that a journal entry is not required because nothing is materially changing Company A's financial position from this authorization. Yes, their board of directors say you can issue these shares if you want to, but they're not issuing them. Therefore, they're not raising any money, and they don't have to. They don't owe anybody anything, so there's no liability to record. Nothing is changing within their financial position. We don't have to record an entry. On January 2nd, Company A is going to issue 25,000 shares of previously authorized $2 par common stock, and they're going to do so at $5 per share. Well, now we see the word common stock. Whose common stock is it? What are we doing with it, etc.? Well, this is our own common stock. We're issuing our own previously authorized stock that was authorized on the day before. And this is our first issuance. We're giving it to the public, which means we're going to record this as common stock on our books. So on January 2nd, we know this is going to be a common stock entry. We're issuing these common shares to the public in order to raise capital to operate our business, to expand our business, which means we're doing this to receive cash. So the debit in this entry is going to be to cash. For how much? Well, to determine how much cash you're going to get, it is the number of shares issued times the market price that we are issuing these shares for. We're issuing 25,000 shares. We're doing so at a price of $5 a piece. Well, 25,000 times 5 means we are receiving $125,000 in cash for the issuance of our own shares of stock. And since this is our own stock, we're going to put it on the books as common stock. And in case we have different pars, it's good form to denote the par on this specific stock. This is $2 par stock, an equity account going up. Well, how much do we record this for? Well, this is going to be for our number of shares issued times the par price. So this is the portion of that $125,000 we're raising, which is attributable to the par value of our stock. So we're issuing 25,000 shares. Our shares have a $2 par value. That means that 50,000 out of that 125,000 can be attributed to the par value of the stock. Our debits don't equal our credits. We know right now that we're going to need another credit of 75,000. Well, what is that 75,000? It's the amount above par that our now owners are paying to invest in our company to buy our equity. It is our paid in capital in excess of par on this common stock transaction, which I abbreviate to PIC common, and you are more than welcome to do so yourself. So we have our PIC common account going up for 75,000, and if you wanted to math that out, it is shares issued times the difference between market and par price. So shares issued times market minus par. And in this particular entry, we issued common shares. The next up entry we have is on January 15th. And on January 15th, Company A, that is us, is going to purchase 4,000 shares of Company B's common stock for $8.50 per share. Well, we see the word common stock again. So do we credit common stock? Well, we got to ask ourselves, what's the nature of this transaction related to common stock? Is it our common stock that we are sending out to the public? And it's not. Company A is purchasing Company B's stock, which means it's not even treasury stock, because treasury stock is our own stock that we're buying back from the public. In this case, we are investing in the performance of another entity, and of Company B. So we're going to call this equity investments. And assuming we don't have significant influence, which you're free to assume, we're going to put this on the books at its basis. And the basis is what we're paying to acquire. Well, that is going to be our number of shares purchased times the purchase price per share. I'll call it the per share price. We are buying 4,000 shares at $8.50 each. 4,000 times $8.50 is $34,000. So the value of this investment that we are making in Company B is going to have a basis of $34,000, because that's what we paid initially to get into that company. And speaking of paying to buy into that company, we got to account for the fact that we are sending them this $34,000 by crediting our cash for $34,000. And here we purchased common shares of Company B, making an equity investment. And on to our next entry. And our next entry on February 1st, Company A is going to repurchase 8,000 shares of its previously issued $2 par common stock from the public, and they're going to do so at a price of $4.20 per share. So again, we have the word common stock in there, but we can't just go on autopilot and put it into common stock. We have to figure out what the nature of this common stock changing hands is. Is it our shares that we're selling to the public? No, it is not. Is it someone else's shares that we are purchasing? It's also not. It's our shares that we're purchasing. And when you purchase your own shares back from the public, that goes into your treasury stock account. And in this case, I'm going to call it treasury stock common. This is a contra equity account, and it is increasing in value. And we put this on the books for the shares purchased times the per share price. So the same exact formula that we used above for our equity investment, but we're not going to put this in equity investments because it's our own shares. And we are going to find out that if we buy 8,000 shares at $4.20 per share, then we're going to spend $33,600 buying that back from the public. And since we are the ones transferring money to another entity, in this case sending cash out to the people that are now former shareholders, we need to decrease our cash account by that purchase price. So we're going to credit cash with $33,600 in this journal entry where we purchased previously issued common shares. Next up, we have February 15th. Company A is going to sell 2,000 shares of its common stock investment in Company B. Again, we have the words common stock. So is it our stock that's moving around? It's not. It's Company B stock. We invested up here on the 15th in Company B. And now we've decided we're going to sell off some of our investment in Company B. So on February 15th, we're selling something. And when you sell something, hopefully you get paid for it. So we know we're going to have to debit cash. And we're going to debit cash for the number of shares sold times the per share sale price. So how many shares are we selling? We're selling 2,000 shares. We're selling those shares at $7.30 a piece. Well, if we're selling 2,000 shares at $7.30 per share, we're receiving $14,600 in cash at the time we are making the sale. The rule for investments, or treasury stock for that matter, doesn't matter which one, is that when you take it off the books, you have to take it off the books at the same cost basis that you put it on the books for in the first place. Which means, I'm going to skip down to our third line, we're going to have to remove these shares from our books at their basis. So we're going to take the number of shares sold and multiply it by the cost basis per share. Well, we're selling 2,000 shares. We sold them at $7.30 a piece, but how much did we pay to buy Company B stock originally? Well, if we scroll back up, we see that when we invested in Company B up here on January 15th, we paid $8.50 per share. So to figure out how much we paid for these 2,000 shares that we are now selling, We multiply the number of shares we're selling, 2,000, times their basis of 850, and come up with 17 grand. Well, now we know our debits don't equal our credits, so let's go and figure out what the difference between those two is. That's 2,400. We know we need a debit for 2,400. Well, how could we mathematically get to $2,400 here? Well, let's take the number of shares sold and let's multiply that by the sale price minus cost basis per share. We're selling 2,000 shares. We paid $8.50 for each of those shares originally. We're now selling them for $7.30, so we're taking a $1.20 loss per share, if you will. And if we're taking a $1.20 loss per share on 2,000 shares, that means we're losing in total, there it is again, $2,400. So what are we going to fill in here? Well, this amount that we're taking, $2,400 right here, is a loss because we are selling at a price less than we purchased for. So I'm going to call that loss on investment sale. And losses are their own separate entity. They're basically expenses that arrive to your business from things that are outside of your normal course of operations, but they work just like expenses. They go up with a debit and down with a credit, so I'm going to call them an expense account here. And then the $17,000 represents what we paid originally for those shares of company B that we are now selling. And if we're selling shares of a company we invested in, we need to reduce the balance of our investment account by that amount. So we're going to credit equity investments for that $17,000. When we sold company B shares, capitalize that, company B shares at a loss. Following entry, we're moving on to March 1st. And on March 1st, company A is going to sell 5,000 shares of its own $2 par common stock that the company purchased on February 1st. These shares were sold at a market value of $5.70 a piece. Okay, we got common stock in here again. Let's break down how the common stock is changing hands, whose common stock it is. Well, firstly, whose common stock it is our common stock. So are we issuing shares to the public for the first time, or are we selling them back what we had already purchased from them before? Well, it tells us the shares were purchased on February 1st. And on February 1st, if we go back, that's when we bought back our own shares from the public, which we put on the books in the form of treasury stock. So what we're doing is we're taking shares out of the treasury and selling them back to the people that originally sold them to us. March 1st, we know we're selling something, so we're going to start with a debit to cash. We can find that by taking the number of shares sold, and we're going to multiply that by the per share sales price again. So here we are selling 5,000 shares, and we're selling them at $5.70 per share. So if we take 5,000, we multiply it by $5.70, company A is going to be receiving $28,500 in cash for reselling these shares out of their treasury. Just like we did up here with equity investments, we need to take this stock, these treasury shares, off our books at their basis, at the price that we originally paid for them. So I'm going to skip down to the bottom line one more time, and I'm going to remove those treasury shares from our books by crediting, treasury stock common, 2 ounce. And that is a contra equity account, in this case, going down. So we're going to find this amount that we need to take off our books by taking the number of shares sold and multiplying it by our cost basis per share. Well, we know we're selling 5,000 shares back. What did we pay originally back on February 1st to buy these shares back from the public? If we scroll back up through our information, we paid $4.20 per share when we bought these back originally. So those 5,000 shares that we are reselling cost us $4.20 a piece, which means we originally paid $21,000 to acquire those shares back from our shareholders, which means our debits don't equal our credits, and we know we're going to need a credit right now to make our debits equal our credits, and that credit is going to be for $7,500. So how do we get to $7,500? Well, if we take the number of shares sold and we multiply it by the difference between our sales price and our cost basis, I got a feeling that's going to come out to 7,500. We're selling 5,000 shares. We are selling those shares for $5.70 a piece. We originally paid $4.20 a piece to buy those shares back on February 1st, which means we're making $1.50 in profit per share. Well, if we're making $1.50 in profit per share on 5,000 shares being sold, that comes out to be 7,500. And that amount, because we are reselling stock, goes into PIC treasury, and that is an equity account going up. And in this entry, we sold treasury stock. So a question that I get asked a lot is, why do you need to record a loss or a gain when you're selling an investment, but it goes into a paid-in capital account when you're reselling your own shares? Well, paid-in capital keeps track of how much you raised by issuing some kind of equity to the public. And in this case, since it's our own shares that we are selling, we can't legally, by GAAP law, declare this as an income statement item. We can't declare this as a gain to increase our profit. I don't know why that rule is, but that is definitely what the rule is. So these two entries are pretty much exactly the same. I mean, our formulas are exactly the same on the side. The only thing that's the real big difference is the difference in value between your basis and the price that you're selling at for your equity investments gets recorded as a loss or a gain, while the difference between the price that you paid originally and what you're selling at for your own treasury stock gets recorded as PIC treasury. Moving on to March 15th, Company A is going to declare a 40 cents per share dividend on its outstanding common shares. So we're Company A, which means we're declaring that we are going to pay money to our shareholders in the future. Well, now we know we owe something, so we have to put it on the books. And what we're intending to do is withdraw money from our company's coffers and give it to our owners, our shareholders, in the form of dividends. So we are going to debit our withdrawal account, cash dividends. For how much? Well, to figure that out, we need to figure out how many shares we have outstanding at this given time of our own common stock. So let's go back through our journal entries and see how many shares the public would actually own, because if you'll recall, we only pay dividends on shares which are outstanding, actually in the hands of the public. So we started by issuing 25,000 shares on January 2nd, and at that point, all 25,000 of those shares were in the hands of the public. Well, on February 1st, we repurchased 8,000 of our own shares. So if we had 25,000 out and we just bought 8,000 back on February 1st after we made that purchase of treasury stock, 17,000 shares would be remaining in the hands of the public. Moving on down the line, on March 1st, we resold 5,000 of those shares back to the public. So there were 17,000 before. We just put 5,000 back into circulation. And that means that on March 15th, at this time, when we are issuing these shares, we have 22,000 shares outstanding in the hands of the public. And we have to pay that 40 cent per share dividend to each of those 22,000 shares. So for cash dividends, we are going to find our shares outstanding, and we're going to multiply that by the dividend rate. And again, to find your shares outstanding, just track all of your stock issuances and treasury stock transactions to figure out at the time you're paying these dividends, how many shares does the public actually own. In this case, we just determined that was 22,000. They're each getting 40 cents, which means Company A is obligated at this point to pay out $8,800 in dividends to their shareholders at some point in the very near future. But we're not paying it yet. So since we're just declaring, we are going to create a liability account denoting the fact that we owe dividends to our common shareholders, and we're going to call it dividends payable common. And we're going to credit that. Liabilities go up on the credit side for that same $8,800. And in this journal entry, we declared a cash dividend. Coming down below, on March 31st, Company A is going to receive a 50-cent per share cash dividend from Company B. Well, now, there's still dividends involved, but we're not the ones sending out the dividends. We're not withdrawing money from our company to give to our shareholders. We're receiving money from another company that we own shares of. So on March 31st, there are no cash dividends to be recorded because, again, that's our withdrawal account. And we're not taking the money out to give to anybody. We're getting the money. And since we're getting the money, it sounds like we're going to just debit cash. How do we figure out how much money we're getting? Same thing. We're going to take our shares owned at the time that we are receiving this dividend and multiply it by the dividend rate. Well, how many shares do we own of Company B at this given time? Let's go back up through our transactions, find everything we did with Company B through the period to figure out how many shares of their stock we still own on March 31st when they're going to send us this dividend. So scrolling all the way back up to the very top, on January 2nd, that's us issuing our own shares. On January 15th, we are purchasing Company B's shares, and we purchased 4,000 shares. So at that time, we own 4,000 shares of Company B's stock. On February 1st, that is a treasury stock transaction. That's not going to count. There we go. On February 15th, we sold 2,000 shares of our investment in Company B. So we had 4,000 shares from our original purchase on the 15th of January. On the 15th of February, we sold 2,000 of those, which means we have 2,000 left that we still own. Our level of ownership in Company B is 2,000 shares. Did anything else happen in March with Company B's stock? And as we scroll through, no. So at this point, we still own 2,000 shares of Company B. And Company B is paying a cash dividend of 50 cents per share, which means we are going to receive $1,000 in cash. Do we have to create a dividends payable liability? We do not, because we're not the one paying the dividend. We're the one receiving the dividend. This dividend that we are receiving is ultimately going to end up increasing our income for the period. And when you have any item that's going to increase your reported income for the period, you need to record it as a revenue. So we're going to call this dividend revenue. We're going to credit that for 1,000. And here we received a cash dividend from Company B. So lastly, at the end of the period, let's figure out what we have in terms of shares that we've authorized, issued, we currently have outstanding, how many we have in treasury, and how many shares of Company B we have. Because when we make our financials, we're going to have to disclose all this information to users of our information. So shares authorized is just that. It's the number of shares that your board of directors said you can distribute to the public. It doesn't matter if you actually did distribute them. It doesn't matter if you bought any of them back or resold them or any of that stuff. Shares authorized is just the maximum amount of shares that you are allowed to issue at this given point in time. So if we scroll back to our very first entry, our board of directors authorized 100,000 shares of this $2 par common stock. So our shares authorized is 100,000. Shares issued is the number of those authorized shares which we have sold to the public at any given point. Like for the very first time, we took them out of our authorized shares that have never been issued before, and we, for the very first time, had that initial public offering of those shares to potential investors. So it's the portion of authorized shares that actually made it out. Well, let's go through, and we see that we issued on January 2nd 25,000 shares of this previously authorized $2 par common stock. So we had 25,000 shares issued there. Scrolling down through, our January 15th entry is us buying someone else's stock, so that definitely doesn't matter for shares issued. On February 1st, we're repurchasing our own shares. Well, that doesn't matter with shares being issued. And then on February 15th, we're selling some of our stock investment. Doesn't matter for shares issued. On March 1st, we are selling 5,000 shares of our own $2 par common stock. And this is the one that hangs people up. we are selling stock back to the public, but this isn't shares that are going into the hands of the public for the first time. They were out there already. We had already bought them back. Now we're reselling them. So if we counted these as shares issued, we'd actually be counting them twice. We would be saying, that we put an extra 5,000 shares of our common stock out into the public. And we really didn't, because before this is going out in the first place, we had bought it back. So the sale of treasury stock, for your notes, never counts as adding to your number of shares issued during the period. So down to the bottom, since the last two entries both have to do with dividends, our number of shares issued is just 25,000. Our number of shares outstanding are the portion of those shares that were issued at any given point, which are currently in the hands of our investors at the time we are preparing our financials. And we already did the math up here for the March 15th entry, but I'll do it one more time to be thorough. We issued 25,000 shares on the 2nd. We bought back 8,000 of those shares on February 1st, thereby lowering the number of shares we had outstanding down to 17,000. And then on March 1st, we sold 5,000 of those shares back, increasing the number of our common shares, which are in the hands of the public at this given time, up to 22,000 shares. So to figure that out, you're going to have to go back through, do some quick calculations to figure out how many of those shares which were issued do our investors actually have their hands on at this given time. And the same is true for the number of shares in treasury. You just have to figure out how many shares you currently own of your own stock at the end of the period. And we already figured that out for our calculations above as well, but we'll go back through. We have two treasury stock transactions. The first one over here is on February 1st. We bought 8,000 shares of our own stock back from our former shareholders. And then on March 1st, we turned around and we sold 5,000 of those shares back. So we had 8,000 from that original purchase. We sold 5,000 of those back, which means at the time we are preparing our financials at the end, we would have 3,000 shares in treasury, which we would have to disclose on our balance sheet. And then lastly, the number of shares of Company B owned, we just figured out in the prior entry. One more time going through. Originally, when we bought Company B's shares on January 15th, we purchased 4,000 shares. We resold a portion of those, at a loss even, on February 15th, where we sold back 2,000 shares, which means at the time that we were preparing our financials, we would have 2,000 shares of ownership in Company B.